Now, the Central Bank of Kenya, that's the CBK, says it will punish banks over the failure to cut interest rates despite the incentive to do so on the same day it cut benchmark lending rate by half a percentage point from 11.25% to 10.75% and reduced the cash holdings requirement for banks by 1% from 4.25% to 3.25% in order to boost lending to the private sector. The CBK says it will conduct physical checks inside banks, ensuring they implement interest rate cuts in accordance with the risk profile of borrowers. Banks risk fines of up to 20 million shillings and daily fines running to 100,000 shillings for non-compliance with the CBK directive. CBK's move to cut the cash reserve ratio, CRR, is expected to free up to 57 billion shillings in additional liquidity that banks can then lend to the private sector. The CRR represents the percentage of deposits that banks are required to keep at the CBK as reserves. The ratio was last revised at the onset of the COVID pandemic in Kenya in March 2020 from 5.25% to 4.25% in a proactive move which was meant to give banks additional liquidity to support borrowers who would be financially distressed by the pandemic.